Welcome! If the stock market feels like a foreign language, this video is your starter phrasebook. In the next few minutes, I'll break down 10 core terms, from bull markets to dollar cost averaging, so you can follow market news and invest with confidence. Let's dive right in. Bull market. When prices trend higher for months or years, you're in a bull market, named after the way a bull thrusts its horns upward. Since 1932, the average bull run on the S&P 500 has lasted about 965 days, a little under 3 years, and delivered roughly plus 114% total return. Bear market. Reverse the trend and you get a bear market, a drop of 20% or more from a recent peak. Bears bite hard but fast. The average one lasts 289 days, approximately 9.6 months, with a negative 36% slide. In 2022, for instance, the Nasdaq plunged more than 30% as rising rates hit tech valuations. Quantitative easing, QE. QE is central bank code for inject cash. The Federal Reserve creates reserves and buys bonds, pushing interest rates down and asset prices up. In 2020 alone, the Fed added approximately $3 trillion to its balance sheet, its fastest expansion ever. More dollars chasing the same number of shares equals higher stock prices, quantitative tightening, QT. QT is QE in reverse. Since mid-2022, the Fed has allowed up to $95 billion a month in bonds to roll off its books, draining liquidity and putting downward pressure on risk assets. Fewer dollars in play usually means lower valuations, especially for growth stocks. Short selling. Shorting flips buy low, sell high on its head. You borrow shares, sell high, then hope to buy them back lower. Gains are capped, price can only fall to zero, but losses are unlimited if the stock soars. That risk became real in January 2021 when GameStop rocketed above $500 pre-split, wiping out some shorts entirely. For beginners, I highly suggest to not go that route. Short selling really is an advanced level maneuver. Unlimited downside. If you buy a stock at $20, the most you can lose is that $20. But if you short at $20 and it rips to $200, you owe $180 per share, plus interest and potential margin calls, unless you cover sooner. Dead cat bounce. In steep sell-offs, you'll often spot a sharp but temporary rebound, a dead cat bounce. Traders jump in, thinking the bottom is in, only to watch prices make fresh lows. Even a dead cat will bounce if it falls far enough. That's the grim metaphor. Don't fight the Fed. Wall Street's oldest maxim. Don't fight the Fed. When policy is loose, QE, rate cuts, odds favor rising asset prices. When it tightens, headwinds build. 2020 proved the point. The real economy shut down, yet stocks finished the year up double digits because stimulus overwhelmed bad fundamentals. Dollar cost averaging, DCA. DCA means investing a fixed dollar amount on a set schedule, no market timing guesswork. Vanguard research shows lump sum investing usually wins on raw returns, but DCA reduces regret and smooths volatility, which helps beginners stick to their plan. Tax loss harvesting. Selling losers to offset winners is tax loss harvesting. U.S. law lets you deduct losses against gains, or up to $3,000 of ordinary income, but beware the wash sale rule. Rebuy the same or substantially identical security. Within 30 days, the IRS disallows the loss. Support and resistance. Chart watchers draw horizontal zones called support, a price floor where buying shows up, and resistance, a ceiling of selling. When resistance breaks on heavy volume, that level often flips to new support and vice versa. Simple, but it frames millions of trading decisions each day. And there you go. 10 translations from Wall Street speak into plain English. Hit subscribe for deeper dives on ETFs, dividends, and portfolio building. As always, invest smart, invest steady.